It's worse than we thought as consumers max out their credit cards. I'm your host, Steven Van Metre, and thanks for joining me today. And normally a surge in consumer credit, particularly with credit cards, is a sign of a booming and healthy economy. But today, it's a sign of an impending recession. Let's head over to Bloomberg. We picked today's story up as U.S. consumer credit surges again as loans, card spending jump, and non-revolving credit, including auto and school loans, rose as U.S. consumer borrowing surged again in April, following a record jump a month earlier, fueled by rising prices and the continued strength of the American consumer. And there is a story that, and this is how it gets interpreted, that, well, people are out using their credit cards, so it must be that things are really good. Because if you think about it, what do we use credit cards for? To buy things we can't afford today and pay for them over time. That's the whole purpose of it. Now, I know some of you buy things with credit and pay it off, but the general idea is you can buy something now and pay it off over time. Now, why would we do that? Well, it's pretty simple. If you're optimistic about your future wages or maybe your income rising, perhaps you find out you're going to get a bonus at work or a pay raise or a promotion, or you're changing jobs and there's going to be a higher salary. All those are reasons that you could have some instant gratification and use credit cards. But in times of high inflation, that's actually not the case. What happens during periods of high inflation is people can't keep up with inflation and they don't want to lower their standard of living because they're hoping that a bonus, a wage increase, something is coming, well, they'll be able to afford it. And that's what we're actually seeing right now. Its total credit increased $38.1 billion from the prior month after a downwardly revised $47.3 billion gain in March, according to Federal Reserve. The median forecast in Bloomberg survey calls for a mere $35 billion advance. And here you can see the case for what's going on right now is we look at average hourly earnings of all employees when adjusted for inflation by subtracting off the consumer price index. And we note that since most of 2020, without just a brief couple periods, that wages have been negative when factoring inflation. And so we completely understand that consumers can't afford higher prices. And so what do? They ultimately turn to their credit cards. And we can see that somewhat in the data. But what happens after all this is what really gets more interesting. So here's looking at total consumer credit, and I've circled some periods where inflation was high and then peaked. And you can get perhaps a trend. You could see consumer credit rising a bit up to these peaks, but you're not really seeing the big picture except during the great financial crisis. And what happened here is consumers couldn't afford higher inflation, so they charged more, they increased their revolving credit, and then they got to the point where they realized that not only can they now are not getting those wage increases or their investments aren't growing, everything's going the other direction, and they actually had to start cutting their spending, cutting their use of revolving credit, and start to pay down that debt. And that had massive repercussions across the economy. And that's the risk we face today as we see consumer credit surging to new highs, facing what could be an outright collapse. As revolving credit outstanding, which includes credit cards, increased $17.8 billion after surging $25.6 billion the month before. Non-revolving credit, which includes autos and school loans, rose $20.3 billion after sizable gains in the prior 2 months. And here we can see in the same article, Americans have so far continued to spend in the face of surging prices, including April, when personal outlays rose 0.9% from the prior month. And adjusted for inflation, spending also increased. So when analysts look at this, they say, wow, the consumer must be really optimistic. No, they're trying to deal with higher prices. And because it's not just isolated, it's higher energy, it's higher food, it's higher rent, higher housing. You see higher across the board, the consumers just don't have much margin for error to start cutting back. But they'll be forced to before long. With inflation largely outpacing wage growth, as I pointed out, consumers have leaned both on savings and credit cards to pay for everyday essentials and discretionary purchases. So here you can see again in the same article, the tone has changed of what is normally a sign of confidence is now a sign of weakness, as the saving rate is at its lowest level since 2008, and a record 537 million credit card accounts were opened in the first quarter. If you can imagine, that is a staggering number. And now we can see how that flows across the rest of the economy, because today, well, we saw the wholesale inventory data rose 2.2%, but trade sales only rose 0.7% back in April. So we talked about the other day these rising inventory levels that Walmart, Target, and other retailers are facing, and it's getting worse at a point where consumers are just trying to maintain. They're having to turn to credit cards to do it. And when they finally realize that the wage growth is not coming, they'll start to cut their spending at a point where these inventory levels are going to continue to rise, forcing, of course, retailers and wholesalers to start cutting. And that's how you start to get that flip from inflation to disinflation. And while that's positive in the same sense that consumer spending is by far the largest contributor to the U.S. economy, it could be concerning if Americans fail to keep up on payments. And that is ultimately mean a slowdown in the pace of inflation-adjusted consumption. Judging by Bank of America, that may already be happening as car spending for household moderated to 4.3% from a year earlier in May, the group said in a recent report. That's down from 6.8% in April and below the expected 8.2% increase in Friday's Consumer Price Index. And now we turn to what the next problem, as it looks to get worse, as the Fed GDP tracker shows the economy could be on the brink of a recession. And you can start to see the early signs of it. Consumers can't afford higher prices, so they turn to their credit cards. Step one, denial. Once they finally accept that, they will turn and cut their spending at a point where wholesalers and retailers have so much inventory, and we're continuing to see inventory come in as China's about to start reopening and shipping goods again. They're going to be stuck with inventory looking to start cutting, and now we're then facing a potential recession, and that leads to unemployment. As a widely followed Federal Reserve gauge is indicating that the U.S. economy could be headed for a second consecutive quarter of negative growth, meeting a rule of thumb definition for recession. In an update posted Tuesday, the Atlanta Fed's GDP Now tracker is pointing to an annualized gain of 0.9% for the second quarter. Notably, this thing is usually inaccurate to the upside. Following a 1.5% drop in the first 3 months of the year, the indicator is showing the economy doesn't have much further to go before it slides into what many consider is a recession. And talk of recession has accelerated this year amid surging inflation and has put a damper on corporate profit outlooks, as we looked at just in yesterday's show, as many in Wall Street are still expecting the combination of resilience in consumer spending and job growth to keep the U.S. out of recession. And of course, the question then is, if we already know that consumer spending is likely to fall when consumers finally find themselves with too much debt, well, what does that mean for job growth if CEOs are losing confidence and profits start to fall and the economy perhaps slides into recession? Well, the notion that job growth will hold up is completely ridiculous, because here we have GDP growth on the left in blue and a year-over-year rate of change, and on the right we have the total non-farm payrolls on a year-over-year rate of change. And notice as GDP growth heads lower, payrolls tend to follow. And here's the zero bound for payrolls, this line right here in the middle, and you can see as GDP growth falls, and eventually we get negative payroll growth, and that ultimately points to a recession, and that means jobs are lost. And we can see the early signs of this indicating that things are indeed actually worse than we think. But if there's one thing that shouldn't be getting hammered during a recession, well, that's your portfolio. I'll put a link up here to Portfolio Shield and the description below. Give it a check out when you have a chance. Now let's take a look, because now the World Bank is even saying that a recession's coming, and some countries can't avoid it. Let's head over to Wall Street Journal now, where Janet Yellen and World Bank expect elevated inflation to persist as global growth is expected to slow as prices rise, increasing the risk of stagflation. Treasury Secretary Janet Yellen warned the U.S. is likely facing a prolonged period of elevated inflation, while the World Bank sharply lowered global growth forecasts and flagged a risk of recession in many countries. And I want you to understand, where growth goes, inflation follows. So the notion that growth is going to fall, demand is going to fall, and prices are going to stay elevated, well, it's not quite how it all works. But this is what the policymakers see. Ms. Yellen, speaking Tuesday on Capitol Hill, said the White House would likely revise upward its U.S. inflation forecast, which already showed prices rising this year at nearly twice the pre-pandemic rate. I do expect inflation to remain high, although I very much hope that it will be coming down soon, Ms. Yellen said, adding that the Biden administration was updating its forecast from March that inflation would average 4.7% this year. In recent months, consumer inflation has trended above 8%. The numbers aren't locked in, but it's likely to be higher than the initial 4.7% forecast. So what the White House is forecasting, what they're hoping for, is that by the end of the year, inflation would come down significantly to average it out. Well, I think that's going to be challenging, but I do think inflation is coming down, as here we can see the consumer price index in blue on a year-over-year rate of change against crude oil prices using West Texas Intermediate on a year-over-year rate of change. And what do we notice? That crude oil tends to lead the consumer price index lower, and we can see that evidently going on throughout multiple periods here. And we already know on a year-over-year rate of change, despite crude oil prices being high, the rate of change is falling, suggesting that it's only a matter of time before the CPI heads down. And when you, of course, you factor those growing inventory levels, it all makes sense that we will see disinflation. The only question is, will we see enough of it to hit the Biden administration's targets? Citing damage from Russia's invasion of Ukraine and the COVID-19 pandemic, the World Bank said global growth is expected to slump to 2.9% in 2022 from 5.7% in 2021, significantly lower than its January forecast. For the U.S., the bank forecasts growth to slow to 2.5% in 2022. 1.2 percentage points below previous projections, and for inflation to remain above 2%. Well, that's a pretty bold call that I think any of us could make at this point, that inflation is likely to stay above 2% for this year. But hey, you never know, right? But I'll tell you what, there's somebody who made an outstanding call that will be right about where it stood before the COVID-19 pandemic, at least until 2024. New U.S. inflation data to be released on Friday is expected by economists to show the annual rate holding steady at 8.3% in May, near a 40-year high. Overall, the World Bank found in its latest Global Economic Prospects report that current economic conditions resemble the high inflation and weak growth, so so-called stagflation of the 1970s, when oil shocks, which we're having now, high federal spending, and loose monetary policy caused inflation to soar. But what's changing now? Do we have high federal spending? No, we actually are starting to see where actually tax receipts are fairly high, and we're seeing federal spending coming down. What about the Fed? Well, in next week, they're going to massively start tightening, and they're expected to continue tightening over the next several months. So we're not seeing the same conditions. In fact, if we continue to see growth fall, we know inflation is going to fall with it. And the stock market here is an excellent barometer, because now we're going to look at the CPI on a year-over-year rate of change, still in blue, against the Wilshire 5000 price index, year-over-year rate of change in red. And I want to note that here you can see when the stock market, we're going back to the 80s, breaks below that yellow line, well, inflation continued to rise, but not for long. And then we notice after the 80s, if we got out of that period of higher inflation, this is where the dynamic really started to change. As the market comes down, we see growth falling, and then inflation falls. You see the CPI start to go down. Here you can see in the great financial crisis, markets coming down, inflation then falls. You see periods here, market getting down to that zero bound, inflation cools off, market getting down, inflation stays up, but market then rallies, and then of course it falls down and brings inflation down. Here we've seen the market come down, because what do we know? That inflation is also a story of growth expectations. Growth falls, demand falls, and inflation goes with it. And several years of above average inflation and below average growth seem likely, and well, that isn't likely, because as growth falls, inflation falls, and so too will treasury yields, because yields are a function of growth and inflation expectations. And here we can see against the CPI index now, the year-over-year rate of change of 30-year treasury yields, which can have periods where it gets elevated and then they come crashing straight down. And notably, they come down, you start coming down, and then inflation tends to follow, as yields tend to lead the CPI index lower, suggesting that the bond market actually is going to start figuring this out pretty quick, as interest rates are looking like they're peaking and starting to head lower. And that is a sign that not just growth is heading lower, that inflation is now going to start coming down as well. And meanwhile, a Commerce Department report on Wednesday showed imports in the U.S. fell in April for the first time since July, suggesting that demand eased in the face of higher prices. As we pointed out, that's not a good sign for the U.S. economy, suggesting it's shrinking. To address this threat of inflation, Ms. Yellen pointed to the efforts of the Fed to tamp down demand. And of course, what we know, that's going to lead to recession. And unlike the 1970s, central banks in advanced economies and many developing economies have made clear mandates for price stability. And over the past 3 decades, they've established a credible track record of achieving their inflation targets. And how do they do it? Well, simple. By causing a recession. Works every time. I'm Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.